Three numbers. That's all it takes to separate a smart property investment from an expensive mistake. Most people spend months browsing listings and touring open houses, but they never run the numbers that actually matter. Today, you'll learn the exact ROI framework that professional investors use to analyze any deal in under 5 minutes. Here's the uncomfortable truth about real estate investing. The majority of first-time investors underperform, not because the market crashed, but because they never learned how to evaluate a deal. They buy based on gut feeling, agent recommendations, or the belief that property always goes up. But professional investors don't guess. They calculate. Every serious property investor relies on 3 core metrics: rental yield, capitalization rate, and cash-on-cash return. These aren't complex Wall Street formulas. They're simple calculations you can do on your phone in under 5 minutes. And once you understand them, you'll never look at a property listing the same way again. Let's start with the simplest metric, rental yield. This tells you what percentage of the property's value you earn back in rent each year. The formula is straightforward: annual rental income divided by the property purchase price multiplied by 100. Here's a real example. You buy a $200,000 apartment. You rent it out for $1,500 per month. That's $18,000 per year. $18,000 divided by $200,000 equals 9%. That's your gross rental yield. Quick tip: when you see rental yield advertised on listings, it's almost always the gross number. The net yield after expenses is usually 2 to 3 percentage points lower. Always ask for the net figure. In the United States, a good rental yield typically falls between 5 and 8%. In emerging markets like Colombia, Turkey, or Vietnam, you might see yields of 8 to 12%. Anything below 4%, that property is likely in an appreciation market. You're betting on the price going up, not the rental income. Rental yield has a blind spot. It ignores your operating expenses. That's where the cap rate comes in. Capitalization rate measures the property's return after accounting for the real costs of ownership. The formula, net operating income divided by the property purchase price times 100. Net operating income, or NOI, is your annual rent minus all operating expenses. That includes property taxes, insurance, maintenance, and property management fees. Using the same $200,000 apartment, $18,000 in annual rent, minus $4,500 in operating expenses, gives you a net operating income of $13,500. $13,500 divided by $200,000 equals a cap rate of 6.75%. Here's what most beginners miss. The cap rate completely ignores your mortgage. It measures the property's performance as if you paid all cash. That's actually useful because it lets you compare properties on equal footing regardless of how you finance them. A cap rate between 5 and 10% is generally healthy. Below 4% usually signals an overheated market. Above 10%, either a great deal or a high-risk neighborhood. Always investigate why a cap rate looks too good. The third metric is where things get interesting and where leverage transforms your returns. Cash-on-cash return measures the actual return on the money you personally invested, not the total property price. The formula, annual pre-tax cash flow divided by total cash invested times 100. Let's go back to our $200,000 apartment. You put down $50,000. That's 25%. Your mortgage payment is $900 per month. Monthly rent is $1,500, minus $375 in operating expenses, minus $900 for the mortgage. That leaves $225 per month in positive cash flow, or $2,700 per year. $2,700 divided by your $50,000 investment equals a cash-on-cash return of 5.4%. Now compare that to the cap rate of 6.75%, which assumed you paid all cash. With leverage, you invested only $50,000 instead of $200,000, and you're still earning $2,700 a year from it. But here's the real insight. If you find a property where rent covers significantly more than the mortgage plus expenses, cash-on-cash returns can reach 10, 15, even 20%. That's the power of leverage when you find the right deal. Let's put all three metrics together with a real-world example. Imagine you find a duplex listed at $175,000 in Indianapolis. Each unit rents for $900 per month. That's $1,800 total, or $21,600 per year. Step 1. Rental yield. $21,600 divided by $175,000 equals 12.3%. That's excellent. Step 2. Cap rate. Annual operating expenses are $5,600. Property taxes, insurance, maintenance, and a 5% vacancy allowance. Net operating income is $16,000. $16,000 divided by $175,000 equals a cap rate of 9.1%. Very strong. Step 3. Cash-on-cash return. You put down $35,000. That's 20%. Your mortgage on $140,000 at 6.5% is about $885 per month. Monthly cash flow, $1,800 in rent, minus $467 in expenses, minus $885 mortgage, equals $448 per month, or $5,376 per year. Cash-on-cash return, $5,376 divided by $35,000 equals 15.4%. All three metrics check out. Rental yield above 8%, cap rate above 8%, cash-on-cash above 12%. This is what a strong investment looks like on paper. But there's one more step, and most people skip it. Numbers on paper are only half the story. Here are the red flags that can turn a great-looking deal into a money pit. First, vacancy rates. Our calculations assume the property is rented 100% of the time. In reality, expect 5 to 10% vacancy. Always factor that in. Second, hidden costs. HOA fees, special assessments, and major repairs like a new roof or HVAC system can wipe out years of cash flow overnight. Third, the neighborhood factor. A 12% cap rate in a declining neighborhood isn't a deal, it's a warning. High returns often come with high tenant turnover and problem tenants. I've seen properties that look incredible on paper, 12% cap rate, amazing yields, until you realize the area has 25% vacancy and the last 3 tenants stopped paying rent. Always drive the neighborhood before you trust the spreadsheet. And finally, the 1% rule. As a quick sanity check, monthly rent should be at least 1% of the purchase price. If a $200,000 property can't fetch $2,000 a month in rent, the numbers probably won't work for cash flow. Here's your quick reference cheat sheet. Rental yield, above 5% is good, above 8% is excellent. Cap rate, above 5% is good, above 8% is excellent. Cash-on-cash return, above 8% is good, above 12% is excellent. If all three metrics hit the good threshold or higher, you've likely found a solid deal. Bookmark this video. The next time you see a property listing, run these 3 numbers before you do anything else. It takes 5 minutes, and it could save you 5 years of regret. If this framework changed how you think about property investing, hit subscribe and the notification bell. We break down real estate data every week on this channel. Like this video if the 3-metric system made investing feel less intimidating. And drop a comment. Which metric surprised you the most? Was it rental yield, cap rate, or cash-on-cash return? Let us know below.